Welcome, everybody. Welcome back. This is the Black CFP Series. As many of you have done from last season, this is season 2, where we highlight and be loud for others in our profession, not only just for Black CFPs. It's not for just only the Black community. It is for all minorities and women and all involved. We just want to recognize that it's not all middle-aged white guys, and there is a lot of us that are involved. And so we want to spread awareness, be loud, and show different opportunities that are out there for you as well. And just like you know, on No BS Wealth, this isn't about my firm, Black Mammoth. This is about sharing as much as we can. So today we've got a very special guest who has way more accolades and has been in the media way more than me, Mr. Jason Howell, with his firm. And I'm very excited. I'm not going to do an intro for you justice at all, but I love your background, love where you came from, and love the different side of the coin, being in Washington and obviously your political background and all that we haven't had that type of guest on here before. So I'm excited. I might nerd out, but welcome. Why don't you tell us more about yourself?
Well, Stoy, thank you for having me. And there's nothing more exciting than someone who's interested in you telling your stories. So now I'm excited, since you're excited. Very much appreciate it. I think my story begins, like everyone's story begins with their parents. My parents were immigrants from the Caribbean islands. They met in Canada, and then they moved to California when they got serious, where I was born just as President Nixon was resigning. So my birth began with a political tinge to it. And I think the past 50 years, I'm not 50 yet, but when you look at the past 50 years or so, essentially the life of Gen Xers, there's been so much that's happened economically in this country than meeting the world with what we've done. And so you think of the Nixon presidency and the decoupling of gold from the US currency, kind of a big deal. You think of ERISA, the Employment Retirement Income Security Act, 1974. And that's when I was born. Kind of a big deal. The Revenue Act of 1978 allowed for 401ks, pretty big deal. And so much has just happened, really just happened. And I've kind of grown up with it. I've been learning alongside it unintentionally for a lot of it, and really in the past 10 to 15 years, quite intentionally. It's been a great journey.
I love that. I love how you connected all of that. Obviously, you've told your story many times, but definitely appreciate that. So there's been obviously a lot of changes within what we do and how we operate within our industry, speaking as a whole. And I want to hit upon your firm specifically and your guys' philosophy, specifically in the ESI and the SRI part of it, because that's relatively new. I mean, new in our industry. There are a lot of things are new, but I mean, it's relatively new in the last, 5-10 years. So I want you to hit upon that as well, because that's different than most of our listeners have heard before. But also I want to highlight it more because I believe it's not dying, but it's just not in the media as much. And I want to make sure that we hit upon that.
Happy to, Stoy. It is interesting how new, ESG, SRI, sustainable investing, impact. There's so many different letters, so many different words and vocab words. I spent some time really learning it so that I wouldn't be behind, because in fact, this kind of investing has been around for a couple centuries. Actually started with the Quakers, and especially with the idea around this podcast being there for people who are either minorities or people who have not had all the advantages over time. The Quakers eventually, not at first, but eventually made a decision that they didn't want to be involved with organizations that were participating in the slave trade. And so they pulled back from those organizations and lived their life and created their businesses and did all that. So that's your first sort of tranche at the S, the social part of environmental, social, and governance, and that kind of investing. And so I did a deep dive in 2020, right after the George Floyd murder, because we're sitting here, in the beginning of the pandemic, and kind of helpless to some degree. But thankfully, we there was a response, which was a fantastic experience, knowing you could be the same person in the Zoom as opposed to in the room
Yeah.
around like what's happening with their money. And I got to follow politics, which I love to follow. And so all those CARES Acts, I was doing multiple either letters and started doing videos just to help simplify what was happening so that our clients would be comfortable with what was going on. But in addition to that, I thought after the George Floyd murder, that was just one more too many. And it was, what could I do? What could our firm do? And I don't know about you, but I've always sort of had in my head that one day when I'm very wealthy, I'll be able to give back and I'll be able to change the world and it'll be fantastic. But I'm not there yet. So what could I do? And then I realized I've been getting all of these emails from, in finance world, sustainable investing. It had come up randomly, like a little bit. And I never really followed through with what was going on. I went with what everyone said, which is, it's nascent, it's on its way, it's up and coming, it's not really there if you want to invest for profits. I was like, yeah, that's pretty much it. But then I decided to actually respond to some of these emails and jump on a webinar. And I realized that millennials are interested in this, women are interested in this, people of color are interested in this, Gen Xers are interested in it. The only people who are not interested by stats and surveys that are not interested in this are the people who are already entrenched, who have already had their successes. And financial advisors. And so 6% was the stat from that webinar, and this is in 2020, of financial advisors actually believed in this. 94% did not. And I realized I was stupidly part of the 94.
Right.
And so rather than waiting to kind of learn this on the job over years and years, I decided to look for education in and around this. And I found what's I recently realized is pronounced the CSRIC, the Chartered SRI Counselor, CSRIC. And that was put through the American College. Jenny, the person who put it together, I'm trying to think of her name. It's not Bloom, but it begins with that same rhyming. She partnered with American College and wrote this test and created it. At the time, only about 300 people had it. And I decided this was the way that I could skip basically 5 or 6 years by actually studying the history, studying how it's applied. Jennifer Coombs, studying essentially who's using it. And you know what I found, Stoy? I found institutional investors are already there. Ultra high net worth investors are already there. The people that are bickering back and forth around whether or not we should be going that way are people who don't have a lot of money. People who are on the retail side trying to compete with words and have gotcha moments. But the people who are serious, the CFAs, who are managing institutional wealth, meaning the endowment funds, the insurance funds, the pensions, they are already there. They're already managing trillions of dollars in that world. And we on the retail side are trying to decide whether it's a political thing or not. It most obviously is not. I'll say one more thing and let you jump in. The G people often forget about. That's governance. That's a screen for governance. When you think of governance, you think of risk. We've all looked at our investment portfolios and tried to manage risk, right? So we're already doing it.
Yeah.
And then many of us are concerned about the world and what's happening and how people are treated as employees and how their supply chain and whether there's any human trafficking going on. Many of us sometimes purchase along those lines. That's the S. And the E, ever since Earth Day, we've been worried about what's happening to our planet. And so to the extent that you screen companies out or screen companies in or make tweaks or adjustments, that's just another layer on top of really solid investment analysis. That's what I've learned, and that's what I'm so excited about in that world.
And I love how you brought up the institutional side. I love tracking where institutional money goes because when we're doing our jobs, really that's where the wealth's built. We have a series called Alternative Investing Series, and it's designed around like how do you build your wealth outside of the traditional markets, and it follows a lot of what institutionals are doing. Like, let's be real, they're very, very intelligent and make a lot of money doing so. And I mean, obviously they make good salaries, but I mean for their actual entity. And if they're doing it and have been doing it, why is retail? Well, it's because a couple things for me. One, the retail loves to get rich quick, like meme stocks and all that. Like, we love that part. Two, we deem everything political, right? Environmental right now is political. It's all about politics, right? It's not. We all know that. And then the social side of things, obviously George Floyd thing and that separating a lot of us. Really what it comes down to humanity, right? That's why it's been around forever. That type of investing is about people who care for others. That's really what it comes down to. And yeah, all we're doing is filtering out the riffraff, if you will, there, and to those companies that fit the humanity mold. And it's that simple. That's what retail doesn't get, though. They label it ESG, they label it environmental. Go ahead.
Thankfully, like every issue that we have now in politics, and you mentioned I'm in the DC area and I'm so close to it, and I really do enjoy parsing some of the false logic and sort of false equivalencies that we get from that space. But we hear this from some folks. I'll say that retail is open-minded, and retail is everyone from the unbanked to the people who have a few $1 million. So retail is a huge swath of Americana. And there are many people, thankfully it's some that are coming to our firm, that are interested in this and believe in this and can't be dissuaded by the recent conversations that have politicized it. Just because something is, an issue, an important issue, just because something does stretch along political lines, doesn't mean it needs to be politicized. And that's the difference. Currently, this kind of investing is being politicized because there is an opportunity to further divide us again. And that's what we, as people who are, just here, we have every opportunity to look up and say, let's not just listen to some of the folks who have incentives to essentially divide us. Let's look at the reality of what it is and make a decision on our own as to whether that makes sense. And you brought up the greatest point. If you're investing and you want to invest in a professional way or an academically sound way, the place that you look are the institutional investors. This is where people with the highest educations around investing go. The chartered financial analysts, one of our hardest tests in our industry. That's where they grow up to go when they're very successful and very smart. And the way they're investing is not because it's nice, not because it's politically expedient or progressive. They're investing because it's sane. There's a reason that after the BP oil spill, there was a recognition by the KLD index, which is the sort of ESG index. BP was already kicked out. Now, was it because of what they're doing to the environment? Was it because they hadn't had the spill yet? No, it was because of their oversight, their governance site with what they were doing with their machinery. And then sure enough, something happened. Something really bad happened. Similarly, we had Equifax was kicked out of the KLD index as well. Was it because they were dumping things in the river? Was it because of smokestacks they had? Equifax, right? Was it because they were doing bad things to people? Do they have human trafficking in their supply chain? No, none of that. They had a 0 on the rating for their cybersecurity. And so that was another governance issue. So you say, you know what, you're out of our index. And then what happened? One of the biggest breaches of data ever with Equifax. And so if we're being sensible and logical and realistic and stepping away from the folks who have incentives and, by the way, don't have very good financial understanding, by the way,
right.
Then you'll evaluate this for the merit. And the merit is, just like any other investment philosophy, it's another way. It's not passive. It's another layer. So you're going in, you're being a little bit active. But those who believe that they can enhance what they're doing with efficient market theory or adaptive efficient market theory are welcome to do that with more data. And that's why there's advocacy for the SEC to make more data available, not to restrict anything, but to make more data.
Absolutely. I love that part. So that's a lot of information, right? That's a lot of data, if you will, for the everyday person. And I know because of the pandemic that everyone was at home. They were doing a lot of research. We obviously saw the influx of retail coming in. Stimulus helped all of that.
Sure did.
Where do you feel we've gone from 2022 to 2023 in regards to that space of so much data, so many people sitting at home doing their own thing? Where do you believe those people are at now? And what do we need to do in our industry to make sure that we can capture them from our point of view?
Well, some of those people are not for us to capture. And I say that because there's a distinction that I believe in this profession. And I want the people who are in community with me, who didn't come from a family that had financial advisors, who are jumping into this sort of feet first for their own interests and passions, to recognize this. There is a difference between a wealth advisor and a financial coach. And so some of the people you mentioned could benefit greatly from a financial coach to show them the things that they would read about in Dave Ramsey's book or Susie Orman's book, and really be there as an accountability partner once a month or once every couple of weeks when they get a paycheck. A fantastic need for that. But then there's this other world called wealth management. And there are people who actually have succeeded within the community that we're speaking to. There are women that are millionaires. There are women that make six figures. There are people of many different kinds of colors and races and ethnicities and from different places that actually are successful. And the narrative of either they're unbanked or they are, Michael Jordan is a false narrative because there's more in the middle there. And my interest these days is ensuring that those people end up having a voice, but more importantly, a resource. Where can they go to? And I'm like, I'm not poor. I'm not a multi-millionaire or billionaire. Can I just be given some of the information that is actually quite helpful? And the space we're in today, and one of the things, as I mentioned, I'm interested in is what you mentioned, alternative assets. There's an entire world of investing that we learned from the experience of 2022. If we didn't know it before,
Right.
That goes beyond just these public markets. And it's the world where people do become, millionaires. Just putting it as it is. That is that world where you don't look for returns of 5 to 6 to 7%. You're looking for returns of 10 to 20 to 30% on average. Where in your venture capital or private equity fund, where some companies are down to zero and some companies have like 5x or 20x. That's the kind of returns you're looking for. So one of the opportunities I think that the public has today, and they're taking advantage of, is exploring this world. Back in 1982, the Securities and Exchange Commission created the rules around accredited investors. And back then, if you made $200,000 a year or $300K with your spouse, or actually significant other, didn't have to be a spouse, or if you had $1 million outside of your home, you were rich in 1982. Where I live, you're kind of an average household, and you're doing okay. And you got to that point in large part because either, you succeeded and had a family that kind of put you on that path and that was it, or you actually just exceeded because you studied and you got your grad degree and now you are a lawyer, and maybe you're a doctor, maybe you're a lobbyist, maybe you're a consultant, you're a government contractor, you're making finally six figures, you're doing very well, but you don't know what to do with it. And you saw last year what happens when you do it yourself. Sometimes things happen that you don't know how to deal with. Stocks and bonds can go down. Oh, I thought that was diversification. Not all the way.
No,
it's kind of.
Right, a little bit. Not always.
A little bit. But now when you talk about that world of diversification broadening to private investments in addition to public investments, it's a new opportunity. The catch is you need to know how to invest in private investments, what kind of private investments, the categories within the categories, and then have access to the ones that are actually good versus the ones that are actually trash. That's the challenge, and that's where I think advisors like you and I, who have already started exploring that area, we can be a great helpmeet to those folks, great guide to those folks. And they're not necessarily looking for us because I don't know that they think we're there, because a lot of times what they hear, even from us within the community, is we are trying to be the financial coaches. But I'm standing up for the people who are willing to be broad and say there's a difference, And I'm in this particular part of the profession with all its compliance, all of its competition, and all its challenge to say that I'm going to compete with the largest private banking arms in the world with what I do. And that's what I hope you do, Stoy, and all of our peers do.
Yeah, I wholeheartedly agree. I'm deeming a modern family office, right? That's what Black Mammoth is. We're a modern family office.
Awesome.
Building that and trying to be loud with that, because not everyone knows what a family office is, but let's just make it simple. It's when some entity, either your own family or not, takes care of basically everything for you. Usually you have to have 25 mil or more. We're modernizing that, meaning it can come down a lot. I think it's around 300,000 to 600,000 of cash flow a year where it could work, or it does work, right?
That's so fantastic.
And that mindset's different, right? It's what you're talking about with wealth management. There is coaching there, but we're coaching a family. We're talking about, bigger picture. We're not talking about, hey, don't go spend that, or a month budget deal, right? We're talking about greater concepts, and that's where we're at too, right? That's where this podcast is designed to help those others that need that spot, right? They can listen to us and do all of that. But really, we're designed for essentially what you're talking about. And it's a lot of business owners. I don't think people realize that there's a lot of business owners out there, small business owners, and they're the ones that are in this realm a lot. And they don't have that person to speak to. They don't understand the alternative world, whether it's access, education, or the concept of the fact that owning your own building for your own business is a good thing, not leasing it out, right? Those little things. And that's what I'm excited the most about, hearing what you're talking about, because there's not too many of us like-minded in that way. And that's why you're saying, I'm going to stand up and be that way. Hell yeah, I'm going to stand up and be that way. Do we understand that it's important to have that coaching one-on-one, that type of stuff? Absolutely. Do I do it for clients? Yeah, I do. Specifically my business owners on a monthly, but it's derived around their financials. It's derived around that bigger picture, not me trying to balance their checkbook every month, right? Those people need it. I get it, but that is a lot of work and not where I want to spend my time. And I don't think that's where my bang for my buck is either. So definitely appreciate your outlook on that, which brings me into okay, there's this big group, right? There's not a ton of us out there. How do we get to those people, and how do they find us in that little space that we're talking about? And little, I mean big, but how do they get to us, and how do we get to them?
Which group are you speaking to, Stoy?
I'm speaking to the ones that we're going after, those ones that have it, just don't have access to being able to do the alternative side and really want to build that wealth. But, where do they go? How does it start?
Well, I wish I had a really good answer for it. If I did, I might be so busy I couldn't be on the podcast. Because here in the DC area, we have 3 of the richest counties in the country, and the model of those folks who have, essentially worked hard and now are sitting in those 6-figure jobs, in part because they have to have it, because they have almost 7-figure homes, and it's not because they live in castles. It's just expensive. Out here, very similar to a San Diego, for example, or not quite a San Francisco, but a San Diego suburb of New York. So you have to be offered that income for your expertise in this area. The biggest challenge, I think, since I started my firm, is this understanding of I know this stuff and I want to stand on the top of a building and just say, come here. But probably the answer lies in being more clear about it yourself, and knowing that there isn't a template for how to say this, developing your own template for saying it. There's an easy template to say, I'm looking for pre-retirees, to manage their money. And that would be so easy. You and I could just stop all this and just say, we're working with pre-retirees, 55, 60 years old, we'll manage your money, see if we're better than Merrill Lynch or Morgan Stanley. And that would be the whole story. And there's people who've done that, and it's a fine business. It doesn't. So I didn't get into this business to do just that, but to be able to hone your story, Stoy, and be able to say, this is who I serve because this is why. I think that's a big part of it. That idea of purpose. And when you start articulating the language around that, then in the back of your head, I don't know if you had any experience working for a firm um, that did sort of focus on sales, but I worked for a large insurance company. And in the back of my head, as I stepped away from that, and was so analytical, and they thought you need to sell more. You're so analytical. You're wasting time. But as I finally got to the space of saying, how do I approach this market that I finally discovered I care about? I realized a lot of the things they were saying that are still in the back of my head. That's the kind of stuff I need to be saying in the language to attract the people I care about. And so you end up going back to that and being very forthright about who you serve and how you serve them. And if you can do that relationship by relationship, my hope, because it's I'm hoping this for me too, is that there'll be a snowball effect, and we'll be well on our way.
Hell yeah, I do. I hope there's a snowball effect, because then when we're overbarded, we have a group of, and be like, hey, I go to Jason. I cannot onboard for 6 more months.
Yeah, I'm done.
Right? Like I'm done. Like I would love that. And to get to, my background is I started insurance as well.
Okay.
For 6 years. Was a managing partner, and it's same thing, right? But you are 100% true, and I'm very much aligned with you. I was analytic. The plan is what's important. There's other pieces that are bigger than life insurance.
What are you doing? You're wasting time.
Where's your 1031? All those things. And that's when
in 2 ways.
Yeah, right. I got started in this, and I'm like, I never connected. And that's why this year we're really focused on growth. And it's because I have to revert back to some of that, like you just said. Obviously not some of those tactics, but like reiterating that and getting it in front of the right people. And I know our mission and my mission personally this year is just to be loud, right? Loud. I don't mean like just, those loud Black people that are out there, right? I mean, I be loud with great information, with the strong support of others, so that way we can be blasted in front of them. Because there's a lot of noise out there. And I bet part of our issue is that there's a lot to sift through. Who to trust, where to go, what to do, all of those things for this group specifically, that it can get overwhelming. And it is. What we do is very complex. There's a lot of complexities to what we do. Our job is to simplify it and educate over time. But if all of that's being thrown at them from the political side to the news side to everyday side, then does that overload them and they just freeze? I don't know. But I do know that they're not getting a lot of us speaking like this in a very just relaxed, like straight, real talk. That's not happening. And that's what I want to focus on, is being loud with all of us and pushing each other forward. Because there's one thing in this industry that people don't understand is there is no competition. The competition is not allowing us to get in front of people to educate them. It is not me and you against each other. There's way too many people out there for us to ever say, you know what, I can't talk to him because he's going to steal my clients. Nope. There's millions, and I can't take that many on. I don't want to. I know you don't want to. But it's providing a place for us all to come together and really, as a community, our community, saying we're here and we need to help these people, and they want help. We just need to give them the ability to get to us.
Yeah. Love it. When you think of the largest RIA in our space, right, our RIAs, and it's 300 billion, and then you think Edward Jones alone is 2 trillion. You've got Morgan Stanley is about 3 trillion. Bank of America Merrill Lynch is, I don't know what it is anymore, it's 4 or 5. And there's plenty of assets, of clients within those firms before anyone ever has to worry about competing with each other within the RIA space. And many of those folks are likely underserved, in large part not because the people in those firms are bad people, though there's bad in RIAs, there's bad everywhere. But the biggest reason is, I believe, the model. I think the model challenges folks as they challenged us in the insurance-based brokerage space. I think it's challenging for folks who are in that regular place. And some people can navigate that and make sense of it and make it work for their clients. But there's enough there that are underserved, where you talk about a modern family office, that someone who has $1.8 million, so just under the private banking level, they're not going to get up to that level at Merrill Lynch. Would love to work with someone like Stoy who says, I'm going to treat this like a modern family office. All I needed was 600K. You're one of my top clients. And let me build around you this team of advisors and ensure that all of these things are taken care of, not just with you. You're not my client, your household is my client. They would love that kind of language and talk. I've gotten, and you've probably gotten this too, from people that came our way, where you think of Vanguard as an example. People that have a couple $1 million with Vanguard. One of our clients came to us because they wanted sustainable investing. They weren't certain about Vanguard's ability to do that. Vanguard has obviously gotten in trouble with some of their voting, and so they were looking for that. And so they said, look, and they were so ready. They're like, here's our plan. Tell me what you think. They sent me a 30-page plan. And the 30-page plan was basically their investments and their name and address and age chopped up in 30 different ways. There's no insurance. There's no estate plan conversation. It wasn't a plan. It was a 30-page investment report. By the way, not even really an investment policy statement, which you and I know what those are. It wasn't that either. It was just their numbers repeated in different ways for 30 pages. Well, I should say 28 pages because there's like 2 or 3 pages of
Disclosures, of course.
Right? And so, that's too bad. And so when you know that and you think, wow, it's not like those large firms have these tiny clients that would be better served as coaches. No, these firms have fairly really good clients, right, for RIAs. A 7-figure client's a great client for an RIA, and we would be able to give them all of us. And I think that's why people come to us. Really, when they could go to the big brand name firm, but they come to us, it's because they want an intimate relationship and they want everything taken care of.
And I think that comes all the way back to ESG and SRI, right? I think that comes back to humanity. I think our value comes back to us in just our relationship with them and being there for them, right? Yeah. That's, I believe, our industry shifting. Obviously, RIAs have been exploding, but I think that's where people want. At the end of the day, yes, you can get ROI, you can get return on your stuff, but is this person going to take care of me? And are they going to be able to adjust as we go? That's where we're getting to. I really can feel it in my soul that that's going to be a huge snowball for all of us that are in that space as we get going. Because at the end of the day, the traditional models and traditional investing are one, getting feed to death, but two, that they're all within a very similar range of returns. Like there's not much adjustment there. You need to throw in your other opportunities, your alts and all of those to really build it. And if those advisors aren't doing them because they're stuck in that traditional side, then here we are. That's what we're for.
And the flexibility that people in the independent space have, and someone like you who got your hand slapped for being too analytical, you having that flexibility, someone like you, means that you are going to look into other parts of the investing world, which you've done in alternative investing. And you are going to study not what's happening this year or next year, though you'll pay attention to it, but what are the academics saying? What are the economists saying about the next 20, 30 years? And we know over the next 20, 30 years, the prediction for public investments is much smaller than it was for the past 50 years. And so when we're projecting where our clients are going to be in 20, 30, 40 years, or where their assets are going to be if they're not going to be around in 20, 30, 40 years, what are you using? Are you using what you would find in a Ramsey book at 10, 12%? Are you using what you might find in today's numbers based on the past 50 years at 6 to 8%? Or are you using something more akin to the 4 to 6% that the studies are showing that we're likely to be in for those public investments? And if you are, and the folks don't have enough to make that happen, are you interested enough and curious enough and deft enough to participate in what is happening now? Right now, the U.S. House of Representatives is bandying about conversations regarding the 1982 SEC rules around accredited investors and how much more they should open it up. Right now, we have registered funds and interval funds that can be made to accredited investors that wasn't there before, but that's exploding right now, whether it's Franklin Templeton or First Trust or even BlackRock. So many others are creating mutual funds and ETFs that have an alternative ring to them, and which include things like hedges and private credit and the rest of it right now. And if you're not interested or curious, then you're going to be waiting for 2, 3 years from now to get involved at best. You're waiting for your large corporation to turn its big, Titanic around to change how they do things for people that have less than $1 million. It's a disservice to the public in that regard if that's what you're waiting for, and you have an opportunity when you're independent like yourself to say, I'm going to look into this now. I'm going to be on the far edges of it. I'm going to study before I do anything. And then I'm going to walk my clients through ease by ease, maybe starting with their small cap allocation and then growing from there.
Yeah. And I think it's our responsibility and our duty personally. I really do in regards to that. But I want to end with two more political or policy questions for you. One is near and dear to me, and I get a little heated about it. The other is actually coming up on the 28th. So let's start with that one on the 28th. The hearing about student loans and the student loan forgiveness and what's going on with that. One, what rumblings have you heard? And two, what's your, I guess, stance, but your thoughts on, the forgiveness and where it is and how that happens and what things could happen from a political sense, but also for end users?
The last I heard was that it would likely get reversed. The executive order situation would get reversed, but that doesn't mean it's over. It's going to be mired in the back and forth and potentially go to the Supreme Court. The Supreme Court seems like a group of people that would be stacked against something like that. And so a lot of question about where it's going to be and where it's going to land eventually because of that. But I think one thing to highlight that hasn't gotten highlighted is a lot of student loans have gotten forgiven for people who really had the worst of it, meaning people who went to those private colleges that advertised during the day on TV, the Strayers of the world, the University of Phoenixes of the world, and others. A lot of that debt has been forgiven to the tune of billions. And the administration doesn't get a lot of credit for that, but I don't know why. So, there should be some credit for that because that wasn't the case prior to the past 2 years. And that's fantastic for those folks. People in our space, like you and I, who may have gone to school if they just went to school 5 years ago, right? And they had advantage and they picked a good school and they hope to get the student loan forgiven. That's a different issue than I've had a sibling who's gone to, a couple siblings who've gone to these ridiculous universities that were private and they paid a premium for them. And I'm so thankful that they have a path for forgiveness because that's a waste, going to those kinds of schools. What's happening now in the conversations that are happening now around, why was it $10,000 that Biden wanted to forgive? Apparently there's so many people that $10,000 is actually the difference.
Right.
Which is interesting to me because when I think about student loan forgiveness, I think of the people who are in the six-figure realm. And so I'm not too passionate around what happens with this particular end of the issue. I'm actually much more interested with the interest rate that the U.S. Treasury is charging students on these student loans. Why is it 8 to 9%?
Amen.
What's that about? Because it can. Why hasn't that been changed? Because that's something that can, go to the heart of the issue of these loans is that they are so expensive. If these were 1%, 2% loans, I think the majority of people would say, well, hey, that's on you, man. Come on. We gave you a loan, you couldn't afford it, you wanted it. It's a 1% loan. But when you have loans that are accruing, especially for grad school, while you're in school, and you come out and you do the arithmetic and it'll be, twice as much or 3 times as much what you paid for it by the time, if you ever paid it off. That's why people are using the phrase academic mortgage. That doesn't seem to be right. And so the first issue that I would empower people to run up and speak to is identifying why the U.S. Treasury has this over 8% for folks. And it's not just this year. This was back when interest rates were 0%. So they can't throw the inflation thing at you, or the Federal Reserve raising rates thing. This is a couple years ago when we were at 0% for the federal funds rate. So why is it there? Whatever they say, good to know. Let's fix it. Let's get this down to 1%.
Right.
And let's reimagine all of the people who are in school who maybe make 6 figures, who probably have $200,000 to $300,000 worth of debt, and we're not going to be affected by this current proposal anyway. I'd like those people who are trying to make something of themselves to reduce that from 8 to 1% on the debt and go ahead and pay it back then. They could do that because they're going to be making 200,000 in 5 or 10 years. It's not as daunting when it's a 1% interest rate. That's where I stand on that issue.
I'm 100% behind you. Literally just talked to Rami Pikran for the CFP series, and she's a student loan goddess, if you will. And her stance is, more about forgiveness and all of that. And I said, well, I get that. That's cool. It'll help. But we got to fix the issue, because once that's out and done, paid off, it's gonna happen again. And I'm a huge proponent of the 1%, because think about it economically. The government, our country, wants intelligent, educated people, because intelligent, educated people bring more GDP global to us, right? Like, that's it. They want us educated. Well, if they want us educated, why are they charging us more or the same as private? That's something done. It doesn't add up. So yeah, charge your 1%. You don't need to make money off of your society to get education. Let them educate, because then they're going to pay more in taxes later, which is where you make your money. So exactly. Stop charging 8 and 9%. So I definitely wanted to bring that up, and love your point of view on that. And the other one, we'll end on this one, the accredited investor rule. Obviously, I'm in the private space a lot with our real estate and having our own fund and stuff like that. And what I'm seeing now is this huge younger generation that has not had generational wealth handed down. So they're not going to trigger that. They are accumulating and starting to get their cash flow and salaries up, right? But we know there's an issue there. But they have been educated, they're intelligent, and want to be in the alternative space. Now, again, we've already discussed that there's other ways to get in alternatives. That's coming through, but I'm more speaking on the private, the accreditation side, which is where it hits me in the heart. So what is your opinion on it? Where do you think you see it going? And I just want to hear your advice on that one.
I think, ethics rules for CFP and other things, they always say disclose your conflicts. And so my conflicts is I just figured out that we should be going after these folks in the middle who have the couple $100,000. And I would love to just keep it to them. Just right. In that way, I provide all this value to folks, as opposed to, I can get that myself too. But in all seriousness, I think of crypto. And crypto is essentially an alternative asset class. And we saw what happens when anybody and everyone gets involved and there are no guardrails. And so I would be hesitant to open up the aperture for everyone to just start investing in venture capital. I don't think that benefits a lot of people. What happens now, one of the areas that's a challenge, it's a challenge for me, it's a challenge for you. We're not multimillionaires, so we don't have access to the best Sequoia Capital, the best Andreessen Horowitz funds necessarily. The best we might be able to do is partner with other folks who do. That access issue is huge. Meanwhile, there are some other things that we would have access to that you might find on iCapital or Case that may not be any good. And the best thing we can do is try to filter some of that and see if any of this might be some, wheat in the chaff type of stuff might be the best. If you opened it up to the entire public, then what you would have in the private markets might look similar to the public markets, where it's kind of a mess. There's a lot of behavioral, manipulation, and then there's a lot you can play with just knowing that the public doesn't understand. And so you can just throw anything out there. There might be a whole volume of new private investments that are garbage. So I'm just thinking of this now as I create the logic around my bias. That it doesn't sound like that's the answer. I'd underscore it this way. You just asked me about student loans. The answer that we got, say, in the 70s, 80s, and 90s about being able to excel and exceed and survive in the world was more formal education. The message that was received by academia was, we can have as many clients as we like, no matter what. the message that was received by politicians was, oh, we want people to be happy and successful, so let's give them student loans up the wazoo. And you have these two institutions essentially working together to create opportunity for anyone in a way that they didn't necessarily know to discern. Someone who gets a degree in art has a different opportunity than someone who gets a degree in finance, but the art degree might cost the same. And so you have too many people chasing something called formal education as a pathway to success that for many of them has not been success. And so now we're having to reimagine what that looks like. And I would say in the same world, when it comes to private investments and public investments, we don't need more people in that market as much as we need more people who are coaching them to put two pennies together and save half of it, right? Like, that is what we need more often than not. I always tell whether it's students or people that are in their 20s, if you don't know anything else, just save. Because eventually one of us will be happy to guide you if you have any money. But if you take the little money you have and the SEC releases their restrictions on private equity, venture capital, private credit, and the like, and you throw your $2,000 that should be in an emergency fund onto, some new startup that goes to zero, that doesn't help you, and it doesn't help me as someone that wants you on the back end as a client. I much prefer that you just saved. You take the 3 to 4% interest you can get in a savings account today, which is half of what I can promise you in a long-term public investments and a diversified passive portfolio. Go get your 3% today, get to 5 figures there, and then let's talk again. But in all likelihood, we want you to then maybe dabble a little bit with some passive investing in a fund, S&P 500 fund, and go away, and then come back to me again when you're at 6. I think the public is well served and well suited to do that. Again, from that example with crypto and from the example we've seen with higher education.
That's a very good point. And I'm a very big proponent of, I don't like the rule. I think it needs, doesn't need gone away. Don't get me wrong. To your point, that would be just detrimental, but I believe there should be other avenues to pass a test or something in regards to that. But your 2 points were spot on. And I'm going to highlight those a lot on some of the clips because I think people need to realize that. My example I usually use is like the meme stocks and all that craze. And at the end of the day, who's holding the bag, right?
Right. You don't know. And I will, to undergird your point, it was a kind of a rough way to do it by the SEC in 1982 if you make this much money. And then they didn't index it to inflation and no one changed it. I love the change around getting financial advisors to have access because we have the education. And so to your point, if there's some kind of quiz or something else, there's one that's coming out now or an idea to sort of self-attest. Well, that doesn't work because people don't even know what they're attesting to.
Right.
But yeah, if someone's willing to go through some sort of examination as we did, this is why they exempt Series 65 people, Series 7 people. It's like, you must know something. Then that could be a mechanism for doing it. However, ChatGPT's out there. Now who knows what's going to happen with the test. And so I don't have the best idea around it. I haven't given it a lot of thought. And of course, you and I don't have the responsibility to figure that out now. Right now, we got to take care of our clients.
Amen. Amen. Those that are in that 200 range that are really needing help, don't know where to go, reach out. Reach out to Jason Howell. Reach out to us. We're here for you specifically. Man, it's been great. It really has. This hour flew by. Really appreciate everything that you're doing for your clients in this industry. Look forward to many other conversations as well. And I can't wait to get this one out and see what the public listens to and hears from. But definitely appreciate your time today.
And thank you so much. It's been a pleasure.
Awesome.
The preceding program was sponsored by Black Mammoth. Any awards, rankings, or recognition by unaffiliated third parties or publications are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Black Mammoth. Information regarding specific awards, rankings, or recognitions is available on the Black Mammoth website, www.blackmammoth.com. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to affect or attempt to affect transactions and securities or the rendering of personalized investment advice due to various factors, including changing market conditions. The information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up-to-date, Black Mammoth do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature and is provided for informational purposes only and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Past performance is not indicative of future results.